Good morning and good afternoon, everyone, and thank you for joining us on this webinar, which is hosted by Nucora. My name is April Rudin, and I'm the founder and CEO of the Rudin Group, a global wealth marketing firm, and I'll be facilitating this webinar today. This session will focus in on the rise of the digital retail investor, and we're going to be talking about three main areas. The first one is the rise of the digital retail investor and what that means for financial services in general. Second, which organizations are already responding and how they're responding. And third, where the opportunity lies and how to get started for those of you out there. Before we kick off, I'd just like to go over a few housekeeping tips. Number one, if you have a question that you'd like to ask of myself or the panel, feel free to do so. You can enter it in on the Zoom Q&A feature. We'll host a short Q&A session at the end of this discussion. Also during this webinar, there'll be a few polls, so feel free to interact directly with the polls as they appear. We're looking forward to hearing your thoughts and weighing in on that. And third, this entire webinar will be recorded, so if you miss anything or think a colleague would be interested in hearing it, it will be available on demand for you to rewatch and share. Okay, so let's dive right in. I'm delighted to be here with a great panel of financial services experts. On the panel today, we have Mintu Bhandari, founder and MD of Monument Bank. We have Nigel Syred, head of digital banking at Vacuum Labs, and Nikolai Hack, head of strategy and partnerships at Nucora. So if I could ask each of you to just briefly introduce yourselves. Mintu, let's start with you, please.
Sure. I guess relevant to what we'll be talking about, I've spent about 30 years as an investor, started my career at the Harvard Endowment, and along the way, transitioned from venture capital to hedge fund management to private equity. The last 15, 20 years have been really private equity focused. 12 of those years with Apollo in New York, then London, and then I launched and built up their India platform. So that's all pre-Monument, which I launched a few years ago now.
All right, excellent. Nigel?
Hi, good afternoon, everybody. I develop business for Vacuum Labs. We're a digital design and engineering company who focus specifically on the fintech and financial services markets. I'm an old school banker. Started out in risk management many years ago with some big global brands, moved through the technology side, moved into the technology vendor space, and then transitioned into the full sort of digital transformation space in the private banking and wealth management arena a few years ago, before more recently, the last 2 to 3 years, focusing very specifically on fintech and digital banking.
Thank you. Nikolai?
Yes, hello everyone, I'm Nikolai. I'm the head of strategy and partnerships for Nucora, where we have built the Nucora platform, which helps financial institutions or everybody in the EFS space to build and launch money management propositions, digital first money management propositions. I originally have a consulting background. Then I was part of a team where we built actually a D2C, a robo-advisory proposition in the UK, Exo Investing. We brought that to life, launched it a couple of years ago. And out of that grew a team, and we spun out a separate entity and team that then is now Nucora and turned into Nucora in our work on the Nucora platform. So we have extensive experience in this space of money management across saving, trading, investing propositions, and helping institutions build those and launch those. Yeah, but I also went through the process of bringing one to life myself, end to end pretty much.
Excellent. So thanks again to Nucora for hosting this chat. So let's get started talking a bit about customer demand and market shift. I mean, these are really very interesting times now. We've all seen the huge stats around uptake, digitalization, and the gamification of investing. But let's delve a little bit deeper into what's driving these changes and what the different market segments are demanding here. So Mintu, why don't we start with you? What's your view? Why is Monument sort of launching now, and who are you targeting? And what do you think these consumers are looking for that they're not getting from some of the traditional providers?
Great, thank you, April. If it's okay, what I'll do is really mention the 4 trends that I think are driving a lot of what we're seeing out there, and then I'll relate it to what we're doing at Monument. But essentially, we're seeing, I believe, a genuine democratization of the capital markets happening. The reach is becoming much greater, and the cost points are coming down. So what we're seeing is fractionalization, unitization of various markets. We're also seeing more self-directed activity. So people are getting smarter. They're looking for disintermediation. And I would say that there's also a search for alternatives. People are really trying to, in investment terms, find alpha because they don't feel that they can actually compete directly with, professionals. And so, there's a demonization that's happening in some parts of the market with regard to professionals, but essentially people are seeking for a differential advantage, a different approach, an alternative approach where they may have an edge. And so those 4 trends are going on. For Monument's a very focused, I would say, on a market. We're very focused on the mass affluent audience. It's a very clunky term, but it's basically people that are below ultra high net worth and above retail. And so we define that in the UK as people with 250K to 5 million of liquid net worth. If you have more than 5 million, you're in a private bank, you're well taken care of. If you're less than 250K, you're kind of, relegated to retail. But there's some interesting retail offerings now, app-based neobanks. So there's a lot more opportunity for a better experience in retail than there has been. But that middle has been ignored. And the middle, the mass affluent, I believe, and I'll go on record in saying that I think it's really the largest overlooked and underserved opportunity in the world of financial services today. In the UK, it's half of the wealth. It's 6 trillion of wealth, and globally it's 80 trillion. And the only global player that is targeting that market today is American Express through their card offering, gold and platinum cards. We think that there's an opportunity for fintech, a neobank that is, well managed at its core, providing good banking products globally, digitally first, and layering on top of it services, fintech services that make it easier for this time poor but cash rich community to operate. Because a lot of the mass affluent are doctors, lawyers, accountants, engineers. They're time poor, hardworking, aspirational, building wealth, but they don't have avenues to really, sort of leverage their time. And so we're trying to provide a bank that genuinely provides service and services. Many of those services are white labeled. We don't manufacture them. We essentially provide them through our app as the trajectory is really for us to attempt, and I don't want to overreach, but we want to be a super app for the mass affluent with financial services at its core.
Just a quick question, digging into that a little bit more. Those are some really, huge stats that you're aiming for, and I understand that. Are these the cohort that you're aiming for? Is that made up? What is the age demographic there? Are they sort of next geners? Are they boomers? Is it a big mix? Just digging into who's the target for this.
I think that's a great question. I think that pre-pandemic, I would have said the demographic was probably 35 to 65. During the pandemic, I think it's broadened dramatically. I think everybody has gotten much more comfortable with a digital first offering, gotten comfortable with using all the communications technologies on WhatsApp, and on top of that, Zoom and Teams. And so people have gotten much more adept, I think, across the spectrum of really being able to, exactly, being able to do things that are really digital in a way that a few years ago weren't. So I would say the demographic is more defined by aspirational, time poor, wealth generating oriented individuals. I think the ultra high net worth, they have many options. They're not going to come to us. They're going to have people come to their office to show them where to sign a document. We do that on the app. We have our RMs enter your phone and show you where to sign a document. So we do it digitally. We're trying to replicate, democratize that high-end service through the use of technology. And historically, I think it's an obvious question, why is it that this space was not addressed historically? And the reason is the cost to income ratio never worked in the middle. Okay, so technology has brought down the cost, so it's now efficient and effective to be able to deliver to this space.
Super interesting. And we'll talk a little bit more later about ultra high net worth and digital, because actually the appetite is very high there. Nigel, curious about your thoughts on this. Customer demand, market shift, pandemic. How do you see things from your point of view?
I think up front, it's worth recognizing that there are some common drivers, but there are also significantly different drivers for each segment of the market that we're looking at. And it's worth drawing a distinction between saving, investment, and trading, because I think they're three very different, with different beasts, particularly the savings market, where there are vast differences currently, really depending upon age and economic position. You know, if you're a gig worker struggling with the pandemic and you've got nothing left after paying your rent and eating, it's hard to start thinking about saving. So at one extreme, many people simply need help changing their behavior to become savers, and many fintech applications help with this through approaches that are probably summarized or grouped as behavioral nudging, you know, rounding up type philosophy. Every time you buy a coffee, stick a pound into your savings account, or the goal-based saving philosophy, which is really trying to link the motivation of the reward at the end with the behavioral action of saving. I think at the other end of the spectrum with trading, and you alluded to during the pandemic, the influx of new customers into the low-cost online trading apps, and particularly amongst that younger generation, I think there's a real element of excitement, and that's being driven by social media, by peer group influence. But for me, that's not investing, that's trading. It's analogous for many to the excitement gained from placing a bet on the outcome of a horse race, a football match, or the political race, whatever you prefer to wager your money on. Investment for me is that big different beast. If for no other reason, the time frame, we're typically looking at a much longer time frame than we are with a savings decision or a trading decision. So I think summarizing, if we look today at really the combination of a low cash yield environment globally, booming equity markets globally, much more widely available education on investing, and a far greater choice of channels to market. Ultimately, that's, I think, driving the conversion of savers to become investors, that combination of those factors. And when you look specifically at the channels, there's been an emergence of all the online brokerage platforms in different countries in the world, which make it easier to invest. They give a better customer experience. There's been the emergence of the robo-advisors, which are removing friction in the process, and with their simple approach with questionnaires and model portfolios and low-cost ETFs are really a very easy entry point for anybody who's really new to the investment scene. And we shouldn't invest or forget about the traditional financial advisors. Their increasing use of technology is lowering their costs to serve, which actually means the service levels have gone up. And from a regulatory perspective, particularly here in the UK, there's been enormous pressure on the old-fashioned traditional fee-based models. So today, traditional financial advisors, better technology, plus far more competitive fee models means that there are also a lot more people today who are prepared to pay for advice that they previously wouldn't have considered.
So, thank you so much for that, Nigel. Nikolai, so many different things happening in the marketplace now. Is frictionless a plus or a minus? Just listening to Nigel, when I think about frictionless, we formerly thought of it as such a plus, but where you have all these traders coming into the market, does it feel like play money? Does it feel like really gambling? And then financial advisors, the B2B versus the B2C, with the average age of a financial advisor being 60 plus. What's your point of view here for even more change moving a little bit forward thinking here?
Yes, so I mean, on the friction element, it's a key part of what we talk about when we speak or when we try to advise clients on how to build propositions, that you need to break down the silos. And I think it's something that Nigel said was interesting. We tend to differentiate between these different products, pensions, saving, investing, trading. And the frictionlessness between those, and I think to break down the silos, that's a key element of making them successful. Because in the end, I think we internally, and that's true for the insights of a big organization even more so, we tend to look at those differently because they're differently regulated. They have different revenue streams. They sit obviously in different departments of the bank. But to the end consumer, there's very little difference. It's all money management, it's all my financial future. It's what matters a lot more to the retail client is, and Mintu and Nigel both mentioned some of those elements, is the aspirations you have, the goals you have, the objectives you have, and that could be a property purchase 5 years from now, a holiday next year, or retirement 30 years from now. But that's what matters to people. That's how they get to those goals. And that's the triggering factor of why you start engaging with your money. So if you're able to build a proposition that can capture these different streams and then ideally be fluid between them, so that whether you have the trader type or the saver type or the investor type, but you're able to ideally with one offering that has just accesses different channels, you're able to service all of them. That's the ideal way, and also between them to be fluid. We tend to get to sector or to sectorize the market or the retail audience into 3 broad buckets. So there's those starting out, needing quite a bit of hand holding. They're also in the accumulation phase, so saving more. There's those who are already actively investing. They have a pension because they're probably employed. In the UK, you have the mandatory subscription anyway, or you invest in some funds. You might also be having been talking to an advisor maybe at some point in your life. And then there's the active traders, and all of those, like 3 groups, that have very distinct characteristics of why they engage with the money, of course. But I think the important bit is that for the average retail institution out there, they have these people as their customers already, right? They're already your retail customers, and they look towards their bank, towards this established institution and this relationship that they have, maybe sometimes for many years, for guidance that goes beyond the core products of banking. So not only the cards, the accounts, a bit of lending maybe, but especially the investing and the trading, but broadly mostly, of course, the investing stream. And that could then be via different channels, right? The advice channel or the self-service channel. But the important bit is that they're there. You don't have to acquire these clients; they're there already. You just have to find the trigger that will engage them to become active in those other propositions.
No, that's so true, Nikolai. And that leads us really into our next question, which is about how different financial services firms are really responding to this opportunity, and just talking a little bit about what the opportunity is for them. I know that you've recently done some research, Nikolai, at Nucora. Maybe you could share with us some of the findings from your research.
Yes, absolutely. So we did a quick market overview. I think it's somewhere in the resource on our webpage, but I'm sure we can also put it up on LinkedIn and link to it again just after this event. So we looked at the functionalities that the 25 largest incumbents in this space offer currently between saving and investing, and especially enabling your clients to go from the one to the other. But also we looked at the 5 biggest challengers, which will tend to happen to be, I think 4 of them are UK challengers. And actually, so 25 out of the 30, they offered saving goals, which is kind of the first step in this journey of accumulation to activate somebody who might not even be actively saving. But then it already gets thinner, right? So I think 8 out of 30, they offered this journey from saving into investing. So to actually, which is probably, we talked about the friction reduction. This is the necessary step to help your clients to preserve their purchasing power in, the market environment that we find ourselves in. And across all the functionalities we looked at, so Mintu mentioned roundups earlier, or I think Nigel mentioned roundups earlier, the notifications on market activity, though, to engage your clients, to bring them back into the environment. There were only, I think, 4 or 5 that offered the entire range. So some of them are clearly capitalizing on this and they're recognizing this opportunity. Nordea was there, ABN AMRO was there, ING was there. But it's not across the market, not a broad spectrum that does that yet. In the UK, we have Barclays, launching Plan and Invest, again, an incumbent doing something in that space. So what I think is interesting is that it's not only players that are native to the retail banking space who are thinking or planning to launch offerings there, but there's Goldman Sachs with Marcus. They're currently adding an investing stream and launching a proposition sometime later. I think it is this year. So also from an upmarket segment, clearly streaming down into the retail space. And then there's also complete outsiders that are becoming more active. So we have Amazon getting into the SME lending. We have Apple, of course, with a credit card and their offering. And I think it just shows something very clearly, that the differentiation advantage for, if you want to be active in this space, it does not lie in building this technology yourself. The technology is the foundation, without which none of this works, of course. Without the technology basis, it cannot work. But your advantage probably lies somewhere else. It's in your distribution network or your brand, or the way that you're able to build relationships with your clients. And I think if you're able to leverage those assets, and that is shown by what we can see across the space, then you can build very, very successful propositions and engage clients for very long time frames as well.
Mintu, what's your point of view on that? We have competition coming from unexpected places. I mean, most banks think their competition comes from the global bank next door, but we have even Walmart here in the US launching financial services for their cohort. So how do you see it?
Yeah, absolutely. I think that it's going to change dramatically. In the UK, just speaking to that for a moment, there's a tremendous overconcentration of assets and liabilities in 6 banks. And there's no question, it's always risky to forecast, but I will take that risk and say, I think there is no question that concentration is going to come down. And that those entities are not going to be able to really shift their strategies or their cultures or their legacy technology to be able to adapt to the changes. So what I think we will see is an environment of multi-banking that will happen. So currently, the average customer has 2.3 accounts in the UK. With banks, I think people will have 4 accounts. They will specialize. They will use specialized banks to do certain things for them that are just better. So if there's someone who's especially good at FX, you may use that bank for FX. If there's somebody that's especially good for linking to investment accounts, you may use that. You may view it as a combination of, in sort of a UK to US analogy, a Bank of America Merrill Lynch combination. That there will be new banks that do that. The existing banks are so poorly designed for service. We view them as water companies, as utilities. So they'll, you get a bill every month, and you can kind of see what your cost is and whatever benefit you're getting, which is marginal. but don't expect service. Don't call them because they really don't want to be called. It's a treasure hunt to find their number. So
To say that.
very different environment, a very poor service environment. So I think that will get addressed by new players. I think that the challenge probably for the new players is that for fintechs, the cost of customer acquisition is very high and there's a lack of trust. So their ability to overcome that and position themselves as a trusted entity is not easy. And so, you know, the path we took is we'll get the Bank of England to validate that we're good guys, and we'll have a banking license which is insured by the Bank of England, you know, deposit taking license, not an e-money license or anything like that. So essentially a full-fledged bank so the cost of customer acquisition for us is embedded in our deposit rates. And so it's a very different approach to the market to overcome the cost of customer acquisition and the trust element. And I think that's the big challenge for fintechs that are going to offer very valuable services, very valuable guidance, very valuable opportunities. Their ability to kind of get in front of customers and really get them to open their wallet to them is not easy.
Yeah, I mean, Nigel, having spent time on both sides of the fence, I mean, we had a, you know, we must build it here mentality for a long time in financial services, particularly banking. You know, as Intu stated, you know, the cost of client acquisition for fintechs has been so high. The legacy banks have the clients. Is it a point where everybody needs to sort of cozy up and create more partnerships? Is that the answer, or how do you see things?
I was actually just stepping back. I was going to comment, follow up into from the early challenger banks spending all the money on customer acquisition costs, and the business model to be sustainable very much relies on generating additional revenue sources. So to be frank, the savings products and the investment options were really a marketplace play. They weren't developed by the bank. It was just plugging in somebody else's product offering and taking a referral fee and acting as a sales channel. But I think now we're now seeing a development of that trend, both within the fintech space and the incumbent banks, which is to try and combine those three pillars: digital banking, savings, and investment into the one solution. From the customer perspective, it completely removes friction. You know, just think about it: a single sign-up process, a single KYC process, not having to share your passport and driver's license with 3 different branches of the same organization. But it also means a lot of what I term the overlay added value, behavioral analytics, identifying what you might be able to save this month. The stuff you used to set up a direct debit to pay $100 a month into an investment account, that can all be sort of automated and fluctuate because the bank or the fintech has got a holistic view of your financial position. And I think that's also a very good example of where the best challenger banks and the better fintechs have really adopted a customer-centric approach. You know, if you step back, the early mobile apps provided by incumbent banks, they're just a channel into the old systems, the existing products. They just exist to help the bank sell and service an existing product, as opposed to being something that helps me as a customer manage my financial lifestyle. If I flip that around from the bank's perspective or the fintech's perspective, I'm probably eventually going to get a bigger share of the customer's wallet. And I can now begin to overlay those services around financial well-being and just overall financial management.
What about some of these players from outside the industry, you know, the Amazon, Google that we were speaking about? I mean, haven't they nailed the CX? Haven't they nailed the UX? Isn't that what, particularly if we think about the pandemic here? Nikolai, maybe you could weigh in on that for a moment. I mean, have they set the bar so high that banks really can't reach that?
Well, because you mentioned the pandemic, just like as an aside note, right? You also mentioned Walmart earlier. Like Walmart was the one place that people were always able to go to, right? I mean, just take that circumstance, and it tells you a bit something of the power of a robust distribution network. But then there's other distribution, like digital distribution networks that are even more robust, of course. And we mentioned Apple or Google, and I think it's a very good point to think about that, and also what Mintu said, that if the incumbents are not building these kinds of propositions and are giving clients what they want, somebody else will, right? And if you think about the transportation sector, it wasn't a taxi company that upended the rules of the game. No, it's an outsider that comes in but knows how to leverage technology to their advantage and then changes the rules of the game. And this is exactly how disruptive innovation happens, of course. And there's also, I think, a bit of a misconception that some of the big tech players will become active players. And I mentioned Goldman Sachs and Apple partnering with the Apple credit card. And so some people think, well, Apple will become a bank. They definitely don't. Huh? They won't become a bank, because I think they have a very high awareness of the downsides of directly engaging with consumers over a regulatory business. So they stay out of that market, and they have very little appetite, I think, to go in there. But they will become the vendor of your products to their channels. And very likely they become one of the most important channels for you to sell your products, because no matter how strong your channels and your distribution is, you cannot beat Apple or Google and the access to consumers that they have. And I think this is the important bit for incumbents, but anybody in this space to realize. If you're competing with Apple and Goldman Sachs for clients, then you really have to bring your A game to the pitch, because that's a strong opponent.
For sure. I mean, if we think about it, everybody wants banking services or everybody wants investment services, but do you really need a bank for that? Who's going to provide those services? Which leads us into our next little bit here, which is how do financial services firms get started here? Build versus buy versus partner. We've been talking about that. Is there a silver bullet? Is there one answer? Nigel, what do you see as really the best route for clients here looking to embark on this sort of transformation?
So I think the first comment may be a statement of the obvious, but the starting point should always be the design of the proposition, really understanding the needs of the segments that are going to be targeted and the business model.
Repeat that for our audience too, just to make sure everybody gets that point.
Okay. Yeah. Starting point should always be the design of the proposition, really understanding the needs of the segment that is being targeted. And it's also important to ensure that upfront you develop the business model and the customer engagement model that you need to meet those needs. It's no point having a low-touch digital self-service proposition if the segment expects to be able to pick up a telephone and call you every other day for advice, and vice versa. So that upfront work, most people will go through a process of ideation, market research. You can do it yourself if you have the resource and expertise, or you pull in the external digital experts to help you do that. But then the real key decision is, how do you build the proposition? What's got to be built from the ground up? What components can be delivered via partnerships? And what should be bought? So, for example, do we go out and acquire a particular fintech, or do we purchase a license to a third-party platform? There's many different ways to skin the cat, is the old expression. So there's different approaches that can be taken to meet the same objective, and everything has pros and cons, really depending on what business model are you trying to achieve, what's your internal technical capability, for example, what bandwidth do you have to carry out a program of this nature. But I would say, from a technology perspective, because ultimately we're talking about mobile apps, web apps, etc., that a consumer or business centric and everything else that needs to happen behind them internally. In today's API-driven fintech ecosystem, you can build your solution in such a way that it's future-proofed. As you want to expand your proposition with different types of services in the future, you can plug and play if you've designed things well up front. Likewise, you can swap things in and out. You know, you may find a part of your proposition, the partner you've chosen, or what you've built yourself isn't working for the customers. So flip it in, as opposed to having to re-engineer and rebuild this entire monolithic solution, which is what we would have done 20 or so years ago. I think the other thing to remember is that the word build covers a spectrum, everything from a complete greenfield development to the assembly or gluing together of components that you either develop yourself, you partner, or you buy. And it's not one size fits all. I think the most important thing, and I'll end on this, however, is there are lots of platforms out there that do the heavy lifting for you. So my advice to any of our clients or any of our prospective clients is keep your focus, your time, your money on the things that are going to help you differentiate yourself in the marketplace and how you engage with your target customers or your existing customers. You know, don't reinvent the wheel. If people have already done the heavy lifting, particularly with all the integration touch points, leverage that platform because somebody's already done half the work for you. And then, as I say, focus on the things that are going to really differentiate your proposition and your customer's experience from your competitor down the road.
That's so well said. Thank you for that, Nigel. Mintu, maybe you want to weigh in. I mean, of course, there's no one size fits all, no magic bullet that everyone's sort of looking for. I don't know if you saw the polling that was done in the webinar, but kind of interesting. We've certainly moved away from you must build it here within the banks and the agility, the ability to get to market, and the rise of the digital investor. Just the title here is really pushing all these people and the fintechs into. How is Monument coming to answer that?
Well, I agree with a lot of what has been said. Nigel, I think, said it very well. I think that I'll take an extreme point of view, which is that the focus needs to be, you know, laser focused on your audience and really understanding them. So what we say internally is we want to be inch wide and mile deep in some specific realm, right? And we can have a few of those, but they need to be really point solutions that are amazing and that are really differentiated. Otherwise, you know, they really will just not compare adequately well and won't be as compelling. So that's one thing I think that I agree fully. And I think that speaks to the fragmentation or the multi-banking or the multi-solutions providers that we'll see over time coming with their A game in specific elements and areas. And I think that contrasts with the Googles and the Apples of the world, who I think are trying to be mile wide, inch deep, because they're not equipped to actually, that's not their goal in life, to serve a small niche or to deliver a specific type of service. They want to be the ultimate in blanket approach on certain functionalities, right? So that will be fine and useful for some audiences, but it's not who you will actually rely upon. And the other thing I would add is the regulatory aspects are usually understated and brushed over. In the UK, Marcus Goldman can get no bigger than it is now, which is about 25 billion.
20 billion, yeah.
So above 25 billion, you're ring fenced. Goldman Sachs will never get ring fenced, or Goldman Sachs will stop being Goldman Sachs. So, you know, there will be a limit. And ring-fenced banks have between 600 billion and 1.2 trillion in deposits, right? So you have, I'm just taking Barclays and HSBC as two benchmarks. There are smaller ring-fenced banks as well, but you're talking about a scale, a magnitude, which is not going to be addressed by the big players, even if they want to. They're not. Google is not going to come and get ring-fenced in the UK. There's going to be regulatory nuances in every environment. In the US, there's state-by-state regulatory issues. National bank charter license is very complex. UK licensing, MAS in Singapore, the RBI in India. I mean, the nuances are deep and very constraining. So you have to really be able to understand and adapt to, that. And I think that the fear of the large groups is overdone because they're not equipped. They're not interested in that. It's going to really not serve their models, which are very, very much scale oriented and not specifically deep, customized proposition oriented. So I think that is the likely path where you'll see a lot of specialists. And the thing about the UK that is very positive is we have a thing called open banking, where you can connect through the API architectures to other banks. You can see data. And I think that the future, and now I'm really projecting out, is that whether it's banking or wealth, AI and analytics on the consumer, on their behavior, your banking customer, is going to really inform the products and services that you're offering them. It's not going to be just the individual kind of having a conversation and knowing you. It's going to be analyzing your spending patterns, your savings patterns, your investment patterns, your travel patterns, your demographic data, your social media activity. And all of that is going to come together to create a much more complete and accurate picture of who the client is. And then the firm that can deliver to that, who can actually understand that customer much more deeply than perhaps that customer knows themselves. If you ask a typical customer, how do you want to invest? Do you want to be aggressive? Do you want to be conservative? Are you income oriented? It depends on what week you ask them, what they had for breakfast, what last article they read on what is crashing and what is rising. That is not an accurate way to actually gear investment acumen and a way to really address needs. So the future is going to be looking much deeper, much more thoughtfully, and then really connecting people to two things: education about who they are and what they should be accomplishing, and second, opportunities that actually fit their path and whatever trajectory and risk profile they actually genuinely can accommodate.
So Nikolai, we'll have you wrap up this segment. I think we can all get excited about hyper-personalization, the promise of data, analytics, AI, which, can hyper-personalize products and services, but do it in a way that feels comfortable for most people. I know that for next geners, the idea of all of these things are welcome. And I think the pandemic and the move to digital has really broken down a lot of these fences for most users and investors. Maybe you want to weigh in on that, Nikolai, before we move to questions.
Well, I think just the breadth of what we've mentioned, right? It shows that you have to be very, very picky in choosing the battles you want to fight in this space as an organization when you want to go after this segment and launch something, which is coming to the the original question was when built by your partner. So where is your strength, and to which strength do you want to play? And if you want to build, right, what's very easy to forget is that building never stops. It's an ongoing task. You're not finished, right? This is why we ship something every 2 weeks, and then we have major releases, every other month. So this is what it means to be a technology-focused business. So there are only very few players that are set up to master that challenge, really. And then if you want to buy, then I think when speed to market is of the essence, it makes a lot of sense, right? It saves you time, and you can build on something that exists. Of course, you have to merge two potentially established organizations, and that can be tricky. If you find a good match there, I think it can be a recipe for success, but it's definitely a more complex process Plus, there's only so many targets out there that you can go after, actually, right? So you have to choose wisely and find them, identify them. And then I think, which is why, obviously, I think partnering and letting everybody play to their strength, right? And Nigel mentioned, hey, choose someone who does some heavy lifting for you, right? We've, for example, in our case, we've done a lot of heavy lifting already, right? We live and breathe, the code that we write for this platform to be the best possible product that you can have. We are, definitely inch wide and a mile deep, very, very laser focused on what it is we do. So I think that's the model that we see works best for, across the board, most organizations. You can develop a more customized and integrated solution, and you also should share the risk and the reward, right? Because we're successful when you're successful. So I think this is the best way to look at it, this mixed approach of take something else that somebody else has built, build on top of it, and you develop your own capabilities and also build skill capital on top of that. This is what I would recommend everybody to primarily look at, and then consider the other options, I think, as second and third order down.
Excellent. Let's move to questions. We have quite a few questions in our remaining moments. Nikolai, the first question is for you. Isn't competing with the quality of human advice the only option for smaller or newer players?
Well, I think again, to what I said earlier, I think it's also there. We look at advice, and we look at, let's take investing. There's advice, there's discretionary management, and we look at those differently because, again, they're regulated differently, right? But in a lot of ways, advice only exists because the contact with a person can solve a problem that, the DIY self-service cannot solve, or the experience cannot solve. And I think that's the key, right? Because it might be something administrative, like processing a transfer, or it might be something more conceptual, like explaining a product, for example. So oftentimes we hear clients say, well, I'm in a bit of a conundrum here. My clients aren't sophisticated enough to do self-service, but I can't offer human-based advice to a retail segment because it's not profitable to do that. So I think the trick is, of course, to use technology and build a proposition that does these two things, right? It automates as many tasks as possible for the people that you actually have, and that they can spend as much time as possible with building relationships with your clients, helping them understand the proposition. But more importantly, also, you need to give a completely seamless experience that has as little friction as possible that would require the attention of a person in the first place. It's true. The unit economics are very, very important. And to Nigel's point, you need to have the business case in place before you go into this space. It's not 2015 anymore, where you just build a robo and they will come. We're not in, that's not the time that we're in anymore. But definitely, these propositions with a strong technology basis, they can be done, and they can be done very, very profitably.
Yeah, it really highlights the importance of marketing for me, because shouldn't you have multiple entry points for each one of these offerings? And I think what has hindered some of the all of the firms really is fintechs get really focused in on their technology and touting their technology and forget about the client-centric part of it. The big banks, not agile, can't move, are thinking about their own legacy systems and how they're offering things. So to me, the idea of not the one size fits all, which we've been talking about, but multiple entry points and letting people choose. So understanding your value prop and going out to market and letting people choose. So not too much over segmentation. One of the things that I see people doing wrong is assuming that millennials only want digital and baby boomers only want a human advisor or a human touch. I think that's so wrong, and we need to really debunk that, or that there are products just for women. Women actually are 51%. They're not a niche, maybe on this panel today, but not in general. So Nigel, maybe you want to weigh in on the risk of over segmentation that just alienates clients.
Yeah, I think it goes back to being clear up front what your business model is. So, one or two incumbent wealth managers went down the robo-advisor route a few years ago to try and penetrate what they would define as their mass affluent target market. So it was a big target segment, but they were after people with smaller amounts to invest, and where the cost to serve was significantly lower than having the advisor. But the business model was predicated upon being able to convert a high percentage of these into the advice model, and hopefully their balances are going to grow through time. So I think that for me is just an example of being clear up front what that model is, and looking if advice, do you wrap that into, and compliance costs into your cost of acquisition. As long as you're open-eyed about the business model and the economics.
Yeah.
Does that answer your question, April, or not?
Yes. Well, we're here today to really talk about the rise of the digital investor. So I'm just going to start with Mintu, and we have another question here. Do you think the rise of the digital retail investor will have a lasting impact on financial services firms, or is this some sort of flash in the pan based on macro events today?
I think the direction and the trajectory is very real. It's a question about the velocity. And I think that can go up and down based on, the events in the marketplace, level of liquidity, how much stimulus checks people have to speculate with, things like that. So, I do think that it will go, though, in the direction of technology empowered. And I noticed in the Q&A, there's a lot of questions about people and advice, and Nigel spoke into this a bit. I do believe that the combination of technology and people are going to be the future, at least for the foreseeable future. I don't think that we have a pure technology solution, or are likely to have one in the near term, that people will feel absolutely confident is doing the right asset allocation or what have you, because knowing the customer is still a more complex thing that an advisor can support. So I believe that there will be a people element. One of the taglines we use is we want to be the bank that's using technology and people to empower prosperity. And the idea is that, you have to have that combination, but you can deliver digitally. I mean, you can deliver it over an app, a phone. It doesn't have to be in person. It doesn't have to be inefficient time-wise. So I think that we're moving in that direction. I think the path is quite clear. It's a question of velocity and who gets there in which segments, first and best.
Nikolai?
Well, I think it's a special environment that we're currently in, definitely, given what we've gone through over the last 14 to 15 months now already, right? So the situation is somewhat extraordinary. Of course, if we talk about a lasting impact, or is this just a temporary spike? Because, for example, right, higher volatility normally always means that managed propositions, they lose some AUM, self-directed propositions gain some AUM, because people now think, okay, I can make a buck in the market. For this, especially for the trader segment that we talked about earlier, that's relevant. So there's that, of course, but like taking that a bit out, COVID, and especially the last 3 months, it's just been an accelerator for a lot of things that would have happened naturally and organically over probably a longer time frame otherwise, right? The digitalization of channels, of engagement channels, of offerings, of entire offerings and propositions that otherwise were happening in an offline way. And then, of course, we've talked about the interest rate environment, the macro factors that will prevail, or it might even become more extreme, of how people will have to think about preserving the purchasing power of their earned money. So I think, and then there's the developments like open banking, open finance, that further push the openness of this ecosystem. So there's a lot of trends that make me think that this is definitely not a temporary spike, right? That these, even if these are occurrences that seem somewhat related to what was only a recent phenomenon, I think they have consequences that are definitely going to prevail over this year, over the next years, over the next decade. So I think the important bit is there that, as I said before, to capitalize on this is, and this is also to Mintu's point, it's now technology at the stage where you are able to do it. And technology doesn't solve all the problems. It's not the panacea for everything in that context, but it's a very important stepping point and a stepping stone to get you to a solution, and for you as much as for your end clients.
Yeah, this has been just really a fascinating discussion. I mean, I think we can all agree that while the pandemic has been a global tragedy for so many people, it honestly has been the silver lining has been for wealth management, financial services to move that forward and to provide products and services to people who probably didn't have access before, or move them onto platforms to give them better and more financial services options. So I just want to thank Nucora for hosting this panel and thank each of the panelists here for such a brilliant conversation. Feel free to link in with any of us on LinkedIn if you'd like to ask other questions, or you can contact Nucoro at hello@nucoro.com to ask any other pressing questions that you'd like to ask. So I'm sorry we weren't able to get to all of them today. And just to remind you that the webinar recording will be available in the next 48 hours and will be sent to all of your registrants. So feel free to share it amongst all of your colleagues and friends that you think will be interested in it. So thank you for listening and have a great day, everyone.
Thank you, April.